Okay, let's open the session. So, first of all, thank you very much for coming here. Good morning, ladies and gentlemen. My name is Pascal Frère-Jacques. I'm a Senior Operations Officer at the WorldBank Center for Financial Reporting Reform here in Vienna, Austria. It's my pleasure to welcome you to the WorldBank Center for Financial Reporting Reform Virtual Seminar on Accounting and Regulatory Update for Banks, Supervisors and Regulators. This event is made possible by the generous financial support of the European Commission, the governments of Austria, Luxembourg and Switzerland, and takes place under 3 different programs: the Road to Europe Program on Accounting Reform and Institutional Strengthening, REPARIS, Strengthening Auditing and Reporting in Countries in the Eastern European Partnership, STAREP, and the Financial Reporting Technical Assistance Program from Poland. I would like, before we start the seminar, to make also an announcement that we will have a face-to-face event meeting in Vienna during June 4 to 6, which will be the second IFRS Executive Seminar for Regulators, which will convene banking, insurance and security supervisors from 20 countries. There might be still a few places available, and we still encourage participation from your institutions. You would need to be nominated by them, and please understand that we finance the workshop, but we don't finance travel and accommodation. As for today, the objective of the virtual seminar are to update participants on recent accounting and regulatory changes. Specifically, this seminar will address the transparency of banks' capital position and disclosure requirements for own funds, comparing this to IFRS requirement. That will be the first presentation by Shamim Juman. And the second will be a presentation on the impact of Basel III framework and other regulatory development, including the leverage ratio and liquidity requirement, assessing how banks are coping with these regulatory changes and how this might change their business model. To speak on those 2 topics, we will have 2 distinguished speakers today. We will first have Shamim Juman, who is an international consultant at the Center for Financial Reporting, but will intervene from London. And we'll have then Mrs. Patricia Jackson, who is the Head of Financial Regulatory Advice at EY in London. So we will start by Shamim. Shamim has been working for us, or with us, for a few years already. He has extensive experience in training banking supervisors and regulators. In the agenda, you will see a little resume of his. He's been involved in many international committees at the BCBS, at the IAS, and he has a very depth knowledge of all the topics dealing with the banking and the insurance system. I'm very pleased that Shamim has prepared a very interesting and insightful presentation on RTSs and IFRS 7. And I hope that you will enjoy it as much as I enjoyed reading it. So Shamim, now the floor is yours.
Good morning, everyone. Thank you, Pascal. Thank you for this very nice introduction. I hope everyone is well and you can hear me loud and clear. Welcome again to sunny London. This is a very rare occasion to have the sun shining, and I think it's going to be the whole day today in London. But since we are a bit pressed for time, let's go straight into my presentation. The outline that you can see on this topic, which is I have titled it as Own Funds and Disclosure of Own Funds, is very, very topical now, and it has been very hot potato for a number of years fortunately or unfortunately. I mean, we all know the reason why it is a very critical issue for banking regulators. It comes with the banking crisis since 2007, 2008. And it was sort of, after a lot of discussions in many of these international committees that Pascal mentioned, it was thought and it was believed that everyone realized that the current framework for banking capital, for own funds, because own funds actually is capital, regulatory capital, may not be up to date. Hence, the number of documents, number of papers published by Basel, by the European Banking Authority on this topic. And this session this morning, the first session this morning, is going to focus on actually 5 papers that has, over the past, let's say, year or 2 years, been published in sequence by the EBA in different parts. So there are 5 papers, and all of them, each one of them, address the issue of own funds. The reason why we have published it in sort of 5 parts, it's because, as we all know, it's a highly, highly technical issue, very complex, very arcane, and also very controversial. So the outline today, we are going to have a brief overview what these papers are about, what do they cover, and what are the key messages in each of these papers. Now, if you look at slides number 3, the overall objectives of these papers published by the EBA, the European Banking Authority, these papers are known as RTS. By RTS, I mean Regulatory Technical Standards. And you will see on my slides number 3 there that it all starts with the Basel III framework. As I think you're very familiar with this concept of Basel III, which was published, the last version was published, I think, in 2011. Now, how to apply Basel III, which is an international framework in the European Union, this application, this transposition of Basel III requirements in the EU has been made through the CRD text, which is the Capital Requirements Directive text. And this is also commonly known as the CRR and CRD, which is the Capital Requirements Regulation, and the CRD4. And to apply it for the banks and for regulators, the details of which is going to be through the RTS, the Regulatory Technical Standards. So this is actually what the regulators in the EU will be applying and asking banks to apply. So just to recap basically what's going on is that these RTS, these Regulatory Technical Standards, will be, has been published by the EBA, and they are basically applying the Basel III framework in the EU. Now, on slide number 4, the key objectives of these RTS, again, RTS being Regulatory Technical Standards, I've tried to put into a few key words, in a few key concepts, what these 4 RTS are trying to apply, yes? And what are they trying to achieve? What are the key objectives? So the first and fundamental issue of these 4 RTS is actually to hold the banks into account and tell them you have to hold better capital, so better quality capital. That's the first and foremost objective of these RTS. It's not just about better quality capital, as you will see on slide number 4, but it is also about more capital. So it's about quality and quantity of capital. And the reason why they want to do this is quite obvious, because as was seen during the banking crisis, is that it is the case in the EU, and not only in the EU, but also at the international level, where banks are very knowledgeable in how to play the regulations comparing one country to the other. So this is what we call regulatory arbitrage, where the banks will try to set up or structure some financial instruments in one country to take into account the advantages that they might have in one country. So by applying these RTS, these regulatory technical standards, across the EU in a very uniform way, it's to avoid these regulatory arbitrage and to ensure harmonization across all the jurisdictions. Before, in the Basel II framework, or the way Basel II was applied in the EU, definitely harmonization was not a fact on the ground, I would say. So these RTS are trying to ensure to have one standard, actually it's 4 standards, but it's the common standard, the same standards being applied across the EU, across the board, in each jurisdiction in the same manner, to ensure harmonization, to ensure a uniform approach, and as we know it in the EU language, it's called the Single Rulebook. Hence the word single, to have one rulebook across the EU region. So let's see what these 4 RTS are about. I mentioned 4 RTS, but there is also a 5th standard. Let's not try to get too bogged down on the technical jargons here, but on slide number 5 you will see that actually for the own funds, regulators will need to apply 4 RTS, 4 regulatory technical standards, and 1 ITS, which is 1 implementation standards. So these 4 RTS are dealing with the definition of capital, what constitute capital, what constitute own funds, what are the deductions to each of these instruments, and then the 1 ITS, which is known as the implementation technical standards. This one ITS is about the disclosures, and it provides actually templates for banks to make the right disclosures about these own funds, about this capital. So I hope this is clear. Basically what we're talking then about today is 4 RTS and 1 ITS, and the reason why we call it implementation technical standards for the disclosures is because actually it's about disclosures. It's the templates are provided, it's how to implement these disclosures, and hence the term ITS and not RTS. The 4 RTS are dealing more about regulation, regulatory issues. What are the deductions? What are the definition of capital or own funds for banks? And the ITS is more about the disclosures, how to implement the disclosure requirements. So this is what it's all about. Now, on slide number 6, you will see I have tried to draw a nice chart summarizing in a very brief manner, but hopefully about the key topics, about these first one. The first RTS, which is known as RTS Own Funds Part 1, the key issues addressed in this Part 1, which is the first RTS dealing with own funds, it tries to answer the fundamental question: what is capital? What is own funds? What is the element of Tier 1? What are the criteria for Tier 1? What are the criteria for additional Tier 1? And what are these features of own funds that we're talking? And also the last key areas in this RTS is about how to treat dividends and redemptions. So these are the key ingredients or the key areas addressed in Part 1 of the RTS. So let's try to get a little bit more on the detail side. On slide number 7. So when I mention the criteria, one of the key terms always mentioned when we talk about criteria is about the eligibility. You know, which instruments are eligible to count as common equity tier 1. Now, the term used in the EU is CET1, which is common equity tier 1. And this is the purest form of capital, the best quality of capital that a bank can have. So what would constitute these criteria or these elements of capital, of common equity tier 1? And it's the same approach for additional tier 1. What are the particular criteria and eligibility requirements for additional tier 1? And once you talk about these criteria, about these what constitute eligible common equity tier 1, you must look at the deductions that takes into account. Now, there are many deductions. We won't have time to talk about these deductions in detail in this GDLN. But these deductions are, for instance, how do you treat charges for tax, future tax charges, how do you treat charges linked to pension, how do you treat charges linked to deferred tax, etc., etc. These are charges, deductions also mentioned in the Basel III framework. So they are very common. So it's the same approach in Basel III and in these regulatory technical standards. However, in the EU, these RTS are more prescriptive. They are more specific. They are more detailed than what is mentioned in the Basel III framework. So let me give you one example which will make it all a little bit clearer for you to understand. Is on slide number 8, you will see when I talked about dividends in previously. So what the RTS is saying is that when a bank has made formal decision, there's a formal management decision which has been made to pay, to distribute dividends. These amounts will no longer be eligible. These dividends will no longer be eligible into capital. So it will have to be deducted. As soon as you make this formal management decision, you will have to deduct them. You will have to strip the current reserves or year-end profits from these dividends that will be distributed in the future. They are no longer eligible to be counted as part of capital. So as you can see, this approach, this principle is saying to the banks, look, if you have future payments to make, whether it is foreseeable tax charges, you have future tax charges to make, you will have to, or you have made decision to pay or to distribute dividends. Please be aware that these amounts that are future charges will no longer be eligible for capital. So, in essence, what is happening here, they're trying to strip and to arrive at the balancing number for the capital. What does remain, and is it enough? Because maybe in the past, when banks said, "Oh, we will pay dividend X," they did not strip the reserves or the future profits or the current year profits from these future payments. So they left it, and everyone thought that actually these banks had enough reserves, have enough capital, when in fact they have already made the decision to pay it. And once they made the payment afterwards, then everyone is left with less capital than what we were planning in the first place. So now they're saying, as soon as you make this formal decision, as soon as you recognize these future charges, tax charges, then please remove them from your capital base. And again, this goes back to this notion, this concept of prudence, yes? Don't wait for the last minute to recalculate your own funds. Now, this is the key principle. Once you understand this key principle, then it's the same principle throughout this RTS Part 1. And one of the key aspects that didn't exist before, I would like to emphasize on this, is that when there are a few criteria to make these formal decisions to pay dividends or for future tax charges, then to be deducted from own funds. If you look at slides number 9, the point number 1 here, first of all, and this is why it is very important for you regulators to be aware of these requirements. You as regulators, you should first ensure that the banks are actually deducting these future charges. So this didn't really exist in the past. You know, the responsibility was always on the bank and everyone assumed that we were doing it. But now it is mentioned black on white in the RTS. It's shifting a lot of these responsibilities on the regulators where you have to do these extra works to ensure that the banks are actually making these deductions. That's the first one. Secondly, the amount of profit that will be used as a basis for the deduction, it should be under the applicable accounting framework. So the profit should be calculated under, in the EU, it's the IFRS, of course, which is applicable, but we are, let's say, using the common yardstick, yes? You take the accounting profit, and this is why all these technical standards, they are linked to the accounting framework. And that's very important for you to understand. It's not an internal profit. It's not a profit calculated on a different framework. It's the applicable accounting framework, which in the EU is the IFRS. So the regulators must have confidence in these numbers to ensure that the proper deductions have been made in regarding these future charges. And the third responsibility of the regulators is very, very important. When the bank is making the decision to make these future charges, it must be allowed by the regulator. You have a key role to play here, not only to ensure that the banks have made the deduction, but also that the regulator, that you are allowing these future dividends to be paid. And if you look at slide number 10, and this is where it is very, very important. I wanted to put this in the first box on slide number 10. Even where you have even when there is a contractual or legal provision for redemption. Redemption here means when some shareholders or holders of some of these financial instruments, they are allowed to redeem their capital instruments. So to basically to redeem, to cash in on these instruments. Even when there is a legal or contractual provision for these capital holders, for these investors to redeem their instruments. And this is the crux, the second box on slide number 10. The regulators can overrule the redemption and limit further redemption. So these are very, very new and powerful tool at the hand of regulators in these RTS, where basically you have the power to say no, you will not allow the redemption, or also you will not allow these future dividend payments because maybe the bank does not have enough capital. So I will not go too much because we're a bit pressed for time in all these details, but basically what you need to understand is that these RTS are giving regulators in the EU and any jurisdictions that will apply these RTS the power to say no, to contractual or legal provision that capital holders may have. All banks may have to pay the dividend, and the regulators can say to the bank, no, you don't have enough profit. When you deduct these dividends, you will be left with less reserve than we are comfortable with, so by all means, do not pay these dividends. These are very controversial and also very powerful tool at the hands of the regulators. So it's the same approach. It's the same approach on slide number 11 on the foreseeable tax charges. And notice that on the second hexagon that I've put there, it's the tax liabilities must be in line with the accounting framework. So everywhere in these standards, it links back to the accounting framework, which in the EU is the IFRS. So all these future payments, all these tax charges, all the accounting profits that we are talking about, it must be aligned with the IFRS concept of tax liabilities, fully recognized on the balance sheet, and calculated in line with the IFRS framework, and of course audited as well. So this is basically what I'm saying on slide number 12. I will not read that for you. So recognize the tax charges. If it is not in line with the accounting framework, then the regulators must ensure that these future tax charges are calculated properly or correctly. So on slide number 13, there are other deductions that I mentioned. I don't mention it, but it is mentioned in the RTS, in part 1 of the RTS. So which instruments will qualify as capital, and this one is linked to the company law in the country and fully included. Then deductions is always required. It should be deducted, and if the deduction from the current existing capital is not enough, then it must be deducted from the next level of capital, which is the additional tier 1. So again, the whole concept here on the part 1 is to ensure that the banks, after all these deductions, is left with the best form of capital and the highest quality of capital. That's why you want to strip it of all these future payments, so that what is left is solid, core, good quality capital. Now, on slide number 14, I mentioned briefly the objectives of the part 2 of these RTS. Now, there are 2 objectives on the part 2. One is the requirements dealing with they are banks, but also banks that have a slightly unique structure, which in some countries are known as mutuals or cooperative society, or indeed savings institutions. So the part 2 of these RTS are dealing with these types of institutions. I repeat, the mutuals, cooperative societies, and savings institutions. So what are these requirements in part 2 dealing with these very special type of organizations? The reason why there is just a little bit of background here, the reason why these special types of institutions have been given a very specific and separate RTS is that they are very common in many EU jurisdictions. You know, in the EU there are about 8,000 types of banks, or 8,000 banks different, and in some countries you have a huge number of mutuals, cooperative societies, and also different types of savings institutions, like in Austria, in France, in Germany. And how the RTS the requirements of RTS1 applies to these very sort of different type of institutions. This is taken care of in the part 2 of the RTS. So for instruments which are eligible to count as capital for, let's say, cooperative banks or mutuals, then you will see on slide number 15 where these instruments, these institutions have a very common instruments. That's because their nature for a number, because of traditions, because of historic reasons. And these are very small institutions, right? They are many, taken together, they can constitute a huge part of the banking sector. But on their own, they are quite small compared to the other major players in the banking sector. However, as I said before, because of traditions or historical reason, these institutions have issued over a number of years instruments that are very, where this aspect, this criteria of redemption is common, because the investors, the capital holders in these banks, in these institutions, have invested in these organizations mainly because redemption is allowed at some point. And here, this own funds part 2 is saying that actually the regulators, and this is why I call it the competent authorities, which means you, regulators, for these institutions, regulators in the EU will have the power to limit the redemption. The reason why they wanted to limit the redemption for these institutions is that when the capital holders are redeeming them, because there may be a clause in the contract, there may be a legal or contractual clause in the contract that investors can limit them, can redeem them. Obviously, when you redeem them, then the institution will be left with less capital, because the capital investors have redeemed these instruments. So what the regulators, what this RTS is saying, you as regulators, you have the power to limit or to stop these redemption. Now, needless to say that this RTS was hugely controversial in the EU, because these institutions fought back heavily, and you're still fighting back, saying, look, we are small institutions, we know our customers, we haven't been involved in the banking crisis, we are clean. So why are you designing an RTS just for us? But we all know the story behind this, and it's a long story. It's still rambling on, yeah, it's still going on, but there was a huge backlash against these specific RTS because it's hugely controversial to say to the regulators, you can say to the institution, don't redeem these instruments. Now, what is interesting is that if you're interested in these RTS, especially in the second one, there is a list, because these institutions are very special and they have different names or terms used to describe them in the EU across a number of jurisdictions. In the RTS Part 2, there is a list as an annex at the back where it lists for each specific country what are these organizations we are looking after. And it's quite informative. If you want to know more about these organizations, obviously not their commercial names, but the type of organizations targeted by this. Now, I will move a little bit quickly because I can see that Pascal is looking at his watch a number of times. I'm doing that as well.
Shamim, just
yes.
I'll leave you the time. I think what we're going to do is we'll do a question and answer session at the end of the second session so that you can go comfortably through your presentation. Thank you very much.
Super. Thank you. Thank you. Thank you, Pascal. So this is giving me some breathing space. But this is basically the key aspect of the second RTS, where redemption can be limited. And on slide number 17, this is what I explain in the blue box on slide number 17, is that to impose this limitation on redemption, the main objective is that the capital base of the entity is not eroded by early redemption of members. Now, what is also very interesting in this RTS is that what it says is the regulators, EBA, basically is saying to these institutions, look, if you want to issue instruments and you want to give these redemption conditions on these instruments, fine, you can do it, no problem. But please bear in mind that nothing prevents you from issuing common equity tier 1 where there is no redemption. So basically what the EBA is pushing the ball back in the court of these institutions, saying, look, that's fine. If you want to have instruments where redemption is a condition, is a requirement, fine, no problem. But there's nothing that prevents you from issuing qualifying common equity tier 1 so that you can have enough capital base for your organization. And you see that this has been part of a little bit of a game between the regulators and all these institutions, saying there has been a lot of back and forth, and among the key stakeholders, and it has gone very, very high up on the echelon, not only within the regulators, but outside the regulatory world, where finally we are left with these requirements. And I'm sure that these redemption aspects of some of these capital instruments come on outside the EU as well. It's not something which is common only in the EU. I'm sure that you may, or in some of the countries attending the GDLN today, you may have similar instruments. You may not have it now, but it may arrive at some point down the line. But please bear in mind that redemption is an important aspect for you as regulators to be aware, and that this RTS is giving regulators in the EU the power to stop the redemption. Now, let's move on to the RTS number 3, the part 3, which is on slide 18. And there you will see that there are two key objectives that this RTS is addressing. So now this RTS is moving away from eligibility or the mutuals or the cooperative banks. This one is dealing specifically with the deduction of investment holdings. I'm not sure to what extent these issues are very common in countries in your case. That's why I'm not covering that too much in detail. But basically these are investments through, let's say, when they invest through asset managers. Some banks have investments, and the key purpose of this RTS is to make sure that when banks are investing through asset managers or through other institutions indirectly, and they have exposures to the rest of the banking sector, what this RTS is trying to do is to basically break down the link between Bank A and the other banks, because they might have invested indirectly, not directly, but indirectly in these other banks. So if these other banks are exposed or in trouble, basically the problem doesn't go back through linkages to the first bank. So hence, in order to avoid these problematic issues in these indirect investments going back to the first bank, basically they break it down and they impose some deductions in the first place through these indirect investments. That's the first one. The second one is the use of broad market indices. And again, I think this is not very common in your countries, but this is where banks in some countries were forced to pay dividends based on fluctuations or movement in indices. And guess what? These indices in some countries, because they are so small, these indices may be linked to the credit risk of the same bank. So again, to avoid these problems spreading from one bank to the other, if you're supposed to pay dividends on some indices and these indices are linked, there's a kind of backward loop to your own credit risk, to stop this spreading, then the banks or you are forced to use broad indices, not just very narrow-minded indices that may be linked actually to the credit risk of the same bank. So I explain in slide number 19 a little bit more about this. What are these indirect investments? So if the bank is holding investment in other financial institutions, whether it's through investment funds, whether it's through pension funds, whether it is through mutual funds, they have to deduct these investments. And that's on slide number 19. And for the market indices, the key problem there on slide number 20, it's where the key problem there, it's saying when there are prudential concerns may arise where the institution's own credit risk basically determine the amount of dividends that will have to be paid. They want to avoid this situation where I am a bank. I have structured an instrument that I will have to pay more dividends, the more I am in trouble. So the more I, as a bank, am in trouble, I will have to pay more dividends. And these linkages might be through a link, and to avoid that, through an index. So to avoid that, they want to say, the RTS is saying, well, actually, no, you have to use a more broader index that is not directly linked to your own situation, but is linked to the market. So that's what slide number 20 is saying. On slide number 21, it tells you a little bit more in 3 steps how they're planning to do it. I will not get into the detail, but you have, I hope you have understood the key approach there. But this is what the slide is saying in slightly different word. To avoid, basically, the key word here is on the number 2 of slide number 21. It's to avoid the correlation between future dividend payments and your own credit risk of your own bank. So spread the risk, please. Do not focus it on your own credit risk. And it defines, in point number 3, what constitutes a broad market index. Yes? So banks will be allowed to use only a broad market index, and it defines what is a broad market index, which is the point number 3 on slide number 21. Number 4, it's another arcane situation where it talks about instruments, capital instruments that might have multiple dividends, and this is where the multiple dividends are linked and to avoid a number of different type of payments. So basically what we are saying is put down some requirements where we can have different type of payments linked to these instruments. So where you have multiple dividends. So I've spent very little on this part number 4 of the own funds. I will not spend too much time on it. But what is more important now, because as you have all seen, Patricia is here. But let me finish off with these disclosures, which is very important. Now, one of the issues that we have on the disclosures, and I think the regulators, and it started with the requirements for disclosures on capital, a paper published by the BCBS a few years ago, where it is, my personal view, it's very, very detailed, very, very prescriptive. And basically this is what the EBA has done on the ITS, the Implementation Technical Standards on Disclosure of Own Funds, where they are saying that they have issued templates, very detailed templates, on what ought to be disclosed by the banks regarding these new treatments of capital. So all the, I've covered basically the 4 parts, the 4 RTS on own funds. The ITS on disclosures are basically all these requirements that are mentioned on own funds in part 1, 2, 3, and 4. All the disclosure requirements is mentioned in these templates on the ITS, which is part 5. Now, the reason why the regulators thought that banks need to disclose in detail all these deductions, all these eligible criteria for common equity tier 1 and additional tier 1 is that they thought that the current disclosures in whether in the accounting framework, whether it is in IS1 or the current disclosures made by the banks, they are not sufficiently detailed, not sufficiently explicit. So the regulators had to come in and say, well, there's a lot of confusion around. Basically, that's what they said. So please explain clearly your capital structure and what are you doing with your capital. So if you want to look more into the detail, I have not given you these templates on the slides, but they are readily available on the EBA website when you go do a search in the ITS on own funds. And the objectives of these disclosure requirements, they are on slide number 25. So I've listed the top 3 that, according to me, are the 3 key objectives. But of course, the papers go on and on about these objectives, what they're trying to achieve. And I do invite everyone here to, if they are interested in this, to go and explore a little bit more of these papers. Basically, it's to allow comparison, because one of the other weaknesses that regulators thought during the banking crisis was that they were not able to compare easily the capital structure of one bank to the other, even if they were among the same peer group. So it wasn't very clear what are the deductions taking place, what constitute the capital, etc., etc. So they said, we want something more explicit, more prescriptive. Please start making these disclosures. And I think in one of my slides, and I want to emphasize that these templates, they are not that different. Of course, there are some different elements because of Core Rep and FinRep, which is applicable in the EU, but they are very much aligned with the BCBS requirement, disclosure requirements templates, which I think is still not mandatory yet. But some banks have started to make more disclosures on their capital instruments. So even if they are not 100% applicable or mandatory right now, some banks have clearly moved in that direction. Now, to what extent they will meet all this? I mean, it is an ITS in the EU, so they will have to do it. And it's also linked to the Core Rep and FinRep disclosures. Now, what are these templates? You will see this on slide number 26. I'm not going to read them to you. You can see that. But these are basically the 3 main templates that you have. It's published in the ITS. It's published on the EBA website. So the key one here is the last one, which I guess is a reconciliation, because all this is linked with the accounting framework. It's linked between, it's not linked, I mean, what I'm saying is that the banks will have to provide a reconciliation between the accounting capital and the prudential capital. And it's quite well explained in the templates. But it's a template, either you do it or you don't do it. So this is what these are the information. I mentioned a little bit more on slide 27, what should be disclosed. And the timing-wise on slide number 28, I've mentioned a little bit what is mentioned in these draft implementation technical standards. Now, as I said to you, some banks are not waiting for all this to become mandatory. They have started doing some of these disclosures already. So it's worthwhile going to see on their website what they are disclosing as of now. And I'm sure with time we are clearly entering a new phase where there will be more and more disclosures rather than less. Whether this will help comparison, this will provide more meaningful disclosures, I think the jury is still out on this. More disclosures doesn't always mean more clarity, but I think this will remain to be seen. And I think this will be subjective issues depending on from where you look at it from. Again, these are all linked. All these 4 standards and the ITS, there are interactions. It's mentioned throughout all these documents, linkages, compliance, or whether it is in line with the current accounting framework. So it's not purely prudential or regulatory approach. I think the regulators are now trying to bridge these 2 frameworks. Whether they achieve to do that, I don't know. I mean, it's more through the disclosures, right, to provide this reconciliation. But regulators need to be more aware, especially in your jurisdictions, about what's going on in the accounting framework and to see what are the gaps. And to understand these differences. Having differences doesn't mean it's bad, but regulators should be aware of these differences. So, conclusions on slide number 30. So, key one, the first one, we are talking about quantity and quality of capital here. So this is why these RTS and ITS have been published by the EBA to improve the quality and the quantity of own funds. And the third point is not just to improve it, but tell the world that you have improved it. So make the right disclosures. So that's it from me, Pascal. So Patricia is here. I also have her slides if she's interested, or you might have soft copies, paper copies. But I have it here if you want to.
I've got it, but that would be.
So, Tamim, thank you. Thank you very much for this presentation. You summed it up. Thank you for providing us a guide into reading these RTSs. I think this is very useful because you have given us the main principle, the reasoning behind, and I think that will help all the participants to look into more details and not to be lost in this quite abundant documentation. If I can get a few getaways about that. The first one is better capital, and that was already it's the implementation basically of what is done in Basel III. More prudence, certainly. But 2 other things that are really important to me is regulators are more responsible than before. The onus is on them. It's not only on the banks. They are supposed to have a look. They have a responsibility more than ever. So I think this is a very important thing. The second element that is probably closer to my field, which is the accounting framework. The accounting framework has a preponderant importance here. And we'll see it with the reconciliation. The regulators have also now a bigger responsibility to look at the enforcement of the accounting standard used in the countries. And I think that is also something that is quite important.